A veteran homeowner can refinance a home with a new VA loan if it has an existing mortgage of any kind, VA or not, or any type of monetary lien. VAs have set rules for refinances that lenders must follow to ensure the veteran is protected. Let's look at the different kinds of refinances and the rules that apply. 1. An interest rate reduction refinance loan, or IRL. An IRL describes the type of refinance where the veteran goes from an existing VA loan to another VA loan, either to reduce the interest rate or to convert from an adjustable rate loan to a fixed rate loan. Lenders will usually process an IRL without credit qualifying. In other words, only the mortgage pay history of the existing VA loan is reviewed, and no income documentation or appraisal. This makes it possible for veterans to close on an IRL much quicker than on a standard purchase loan, sometimes as short as 10 to 14 days. To meet VA's rules for IRLs, the principal and interest portion of the new monthly payment must decrease compared to the payment on the existing VA loan. However, there are 3 exceptions to this. A. The IRL is taking the veteran from an adjustable rate loan to a fixed one, or B. The new term is shorter than the existing one, such as, for example, going from a 30-year fixed existing VA loan to a 15 or 20-year fixed, or C. Energy-efficient improvements are being bundled into the new VA loan. In these cases, the monthly principal and interest payment of the new loan is often higher than the existing one, and if that increase is as much as 20%, the lender will need to revisit the veteran's capacity to repay the loan by reviewing income documents. The lender will need to also certify to VA that the veteran does qualify for the new payment that's 20% or more higher than the present one. There are seasoning requirements for a VA IRL loan to be doable. This means a minimum amount of time must have passed beginning with a specific date involving the existing VA loan that's to be paid off, and that specific date would be the latest or more recent of 2 dates. 1. 210 days from the first payment due date of the existing loan, and 2. The date on which the 6th consecutive monthly payment is made on the existing loan. Lenders cross-reference that specific date with the date of the promissory note of the new VA IRL loan to make sure there's sufficient time passed. The lender can charge an origination fee not to exceed 1% of the amount of the existing VA loan's payoff, and not the new IRL loan amount. Discount points can be charged to lower the rate, and up to 2% may be financed into the loan. More than 2% would have to be paid by the veteran. And then additional restrictions come into play if discount points are charged on a VA IRL that's taking the veteran from a fixed rate to an adjustable rate. A. If the lender charges 1% or less in discount points, then an appraisal is required. This doesn't have to be a VA appraisal and the veteran can pay it. B. If the lender charges over 1%, an appraisal is required also, but the new IRL loan is capped at 90% of the appraised value. The funding fee charged on all IRL loans at the time of this recording is 0.5% of the new loan amount, unless of course the veteran is exempt due to disability rating. The veteran cannot receive more than $500 cash back when completing a VA IRL as a result of miscalculated closing costs. Closing costs can be rolled into the new loan. VA has set parameters under a rule known as Net Tangible Benefit, or NTB, to make sure the VA IRL improves the veteran's financial position sufficiently, avoiding what's known as churning, where refinances with no value or benefit to the veteran are completed by overly eager lenders. The NTB looks at 2 important considerations: A. The reduction in rate and payment, and B. The time it would take for the veteran to recoup the costs incurred. A. Reduction in rate. If the existing VA loan has a fixed rate and so does the new one, then the raw rate must be at least 0.5% lower and the payment should be reduced. If the existing VA loan has a fixed rate and the new loan is adjustable, then the new rate must be at least 2% lower. B. Recoupment period for costs incurred. When the new payment is lower than the existing one, VA forces the lender to perform a calculation that computes all the fees and costs incurred on the new VA loan and compares it to the number of months it would take to recoup that expense by means of the lower payment. And that period must be 36 months or less. So for a veteran who incurred $6,000 in closing costs to refinance with a VA IRL and whose new payment is $300 lower, the NTB rule is satisfied because the recoupment is met in 20 months. But for a veteran who paid, say, $12,000 in closing costs for a payment that's $300 lower, the Earl figures don't meet the NTB rules because if that loan were to go through, it would take 40 months to recoup the costs. Prepaid interest on the new loan, surplus funds set aside as an impound or escrow account for tax and insurance, and the VA funding fee if charged are not included in the cost calculations. All other typical charges such as lender fees, credit report fees, flood certification fees, settlement agent fees, and government recording charges, for example, are counted. Lenders can bring the net costs down by applying a lender credit, also known as premium pricing. Say the veteran's costs amount to $12,000 on the final disclosures, and the lender applies a $5,000 lender credit. Then the cost figure that is fed into the NTB recoupment calculation would be $7,000. The NTB rule cannot be applied in the same way when the new mortgage payment is increasing on a VA IRRRL, such as, for example, when the veteran is going from an adjustable rate to a fixed rate or shortening the term of the loan. So what the VA does is make sure the veteran doesn't incur any charges. All costs that would otherwise be fed into the NTB calculation have to be absorbed by the lender. VA IRRRLs can be completed even when a veteran has had prior late payments on the existing VA loan or is presently delinquent. However, if the new loan is rolling in the delinquent payments, the lender can't make the final decision on approval. The file has to be signed off at the local VA jurisdiction known as RLC. Veterans will discover that lenders that will consider an IRRRL on a loan that's delinquent are few and far between. The maximum loan amount on a VA IRRRL can include delinquent loan payments and fees, the VA funding fee, allowable charges such as standard lender fees including up to 2 discount points if charged, and energy-efficient improvements. There's no update made to the veteran's entitlement as a result of a VA IRRRL. The original amount listed on the certificate of eligibility remains as is. Occupancy rules for VA IRRRLs. Most IRRRL loans are done for veterans who are currently living in the home, but a veteran who once lived in the home and has since moved out can still complete an IRRRL on the existing VA loan when he or she is no longer occupying the property. Can there be a change in borrowers on a VA IRRRL? Generally, VA requires that whoever is on the existing VA loan continues onto the new IRRRL loan. However, there are some exceptions. Here are some common examples of acceptable changes to the identity of borrowers on a VA IRRRL. A. Existing VA loan has a veteran who was not married but now is and adds the spouse to the loan. B. Existing VA loan has veteran and spouse, but the veteran is now divorced and goes on the IRRRL alone. C. Existing VA loan has veteran and spouse, but the veteran divorced and remarried, and the new IRRRL loan has the veteran and a different new spouse. D. Existing VA loan has one veteran and the new IRRRL has a different veteran, i.e. one who substituted his or her entitlement through a loan assumption. E. Existing VA loan has veteran and spouse, but veteran died since the loan was originated and the spouse is on the IRRRL by himself or herself. F. Existing VA loan has veteran and non-veteran who were jointly obligated, but the new IRRRL has only the veteran. Veterans should be aware that when there's a change in the borrower's identity on a VA IRRRL, lenders may subject the underwriting process to increased scrutiny. This scrutiny may extend to various aspects, such as income verification, especially in cases where one individual is being removed from the loan, potentially leading to reduced income for covering payments. Now, let's move on to VA IRRRL refinances to talk about the other type of refinance. 2. VA cash-out refinance. Any refinance that doesn't fit the IRRRL rules we've just described falls under the category of cash-out refinance. And as you'll see, that doesn't always mean the veteran is taking out cash from the equity. In fact, the term cash-out refinance applies to refinancing any existing type of lien or mortgage. Example, paying off a mechanic's lien from a contractor, or any type of mortgage including VA, conventional, FHA, USDA, or even private money. The VA has set 2 classifications for cash-out refinances, Type 1 and Type 2. Type 1 is a rarity and occurs when the new loan balance will be the same or lesser than an existing VA loan. An example of when this might happen involves a veteran who received an inheritance and wants to pay down his loan balance and lower the payment. Just like for IRRRL loans, the costs incurred must be recoupable in 36 months or less. This loan must also have a reduction in rate of 0.5% and be seasoned the same as an IRRRL. It's effectively an IRRRL at or below the remaining principal balance. Type 2 is the most common kind of cash-out refinance. Here are the rules that apply. A. The veteran or eligible person, such as spouse for example, must certify occupancy. Cash-out refinances cannot be completed on investment properties even if the veteran once lived there, whereas IRRRL refinances can be done on a home the veteran no longer occupies. B. Unlike on an IRRRL refinance, a full appraisal is required from a VA-certified appraiser. C. In states where pest inspections are mandatory, one must be completed and any infestation dealt with. D. Per VA. The same seasoning period that applies to VA IRRRL loans also applies to cash-out refinances of an existing VA loan into a new VA loan. Although VA is silent on whether the same seasoning requirement applies for VA cash-out refinances when refinancing a non-VA loan, such as FHA or conventional into a VA loan. Having said this, a different law comes into play that does impose the same seasoning on all VA cash-out refinances, irrespective of whether the veteran is going from one VA loan to another or from a non-VA loan to a VA loan. And that law has to do with Ginnie Mae, the government entity that buys VA loans. You see, Ginnie Mae does spell it out and requires the same seasoning on all loans being refinanced into a VA loan. As discussed earlier, this means a minimum amount of time must have passed beginning with a specific date involving the existing loan that's to be paid off. And that specific date would be the latest or more recent of two dates. 1. 210 days from the first payment due date of the existing loan, and 2. The date on which the sixth consecutive monthly payment is made on the existing loan. Lenders cross-reference that specific date with the date of the promissory note of the new VA loan to make sure there's sufficient time passed. E. Unlike on an IRRRL refinance, a full underwrite is required where the VA underwriter will review credit, income, and assets to determine approval. The veteran must re-qualify for the new loan, meeting VA residual income requirements. F. A funding fee is charged and financed into the new loan. However, unlike in VA loans for purchase transactions or IRRRL refinances, the amount of the funding fee can be added to the loan, but total loan amount cannot exceed 100% of the appraised value. G. Net tangible benefit. Cash-out refinances, just like IRRRL refinances, have NTB, net tangible benefit requirements. However, the specific criteria differ slightly, and if any of the following benefits are identified in the loan's numbers, it is considered that the recoupment requirement has been satisfied. 1. The new VA loan eliminates monthly mortgage insurance. For example, going from an FHA loan to a VA loan, or 2. The term of the new loan is less than the original term of the loan being refinanced. For example, going from a 30-year term to say 25-year term regardless of the term remaining on the original loan being refinanced. Or 3. The new loan's interest rate is lower than the existing loan's rate. Or 4. The monthly principal and interest payment of the new loan is less than the existing loans. Or 5. Calculations show the veteran's residual income increases as a result of the refinance. This can happen, for example, when consumer debts are being paid off, lowering the veteran's overall monthly debt obligations. Or 6. The cash-out loan is used to pay an interim construction loan the veteran had taken out to build or remodel the home. Or 7. The loan-to-value is equal to or lower than 90%. Say a home appraises for $400,000 and the veteran's cash-out loan is $360,000. The rule is met. In some cases, if you really need to borrow more than 90% of the appraised value but don't meet any of the other criteria, the lender may creatively suggest a 29-year loan term as long as your existing loan was originally a 30-year loan. Or 8. The cash-out refinance takes the veteran from an adjustable rate mortgage to a fixed-rate mortgage.